Good morning, everybody. Welcome back to Options Brew TV Traders Workshop. I got the lads behind me. You're not going to believe the backgrounds. It's unbelievable. We're going to talk debt ceiling. We're going to talk a little skew today. So let's get ready to rip. Welcome back. What? Welcome back, boys. Look at this.
Good to see you all. It's been a while.
I know. My God, we had a little pre-summer vacation, the three of us from the show, right?
This weather certainly feels like it.
We had some time off.
And we got through Memorial Day. So all good. By the way, speaking of Memorial Day or any day, that's a Monday holiday for the markets, my favorite time because we're already Thursday. It feels like I just started the weekend. I'm already ready for party time on the weekend. It's unbelievable. Can I
see, I like Fridays because then you get synthetic Thursday on Wednesday.
That's a good point. I'm a big synthetic guy when it comes to weekdays. So, interestingly, my wife is off on Fridays, so I always call Synthetic Friday her Thursday, right? Because the next day is the holiday. There you go.
I'm sorry. What's Synthetic Wednesday?
Tell them, Mark.
So, like on Good Friday, Wednesday is Synthetic Thursday. Okay. Like if you have Friday off, Wednesday is your Thursday.
Right.
Okay. Oh, I see.
And at one point during the week,
I was sitting there thinking of synthetic spreads, and my brain is always so mashed in options. It's like,
all right. So, what's in the news? Let's see. We just got through this debt ceiling debate. I don't think we have any great analysis of that whole escapade, unless you have a few comments. But it seems
my comment
not solved, but it seems to be subsided for now, right?
Well, just on the political front, it seems like they came to an agreement. But the big debate that I see on, all social media platforms that between everybody is after the debt ceiling is resolved and the Treasury has to replenish their funds, how fast are they going to do it? And in what tenor are they going to issue those treasuries? And what's the result going to be? I mean, the easy answer seems to be more treasuries, more supply, treasuries come down. Mm-hmm. But, there's a lot of like plumbing, money market funds are keeping all their cash in reverse repo, and they'll just, take out that money if the treasuries are more short tenored. Mm-hmm. And there's, so there's like a debate as to what will happen. In my opinion, though, I mean, I've kind of perused at least through the debt ceiling legislation, and it's enacting a pay-go standard into law, which means that all new spending must be offset by disappearing old spending. Like you have to take money from somewhere in order to pay for the things that you're trying to do. Mm-hmm. So that's going to be handcuffing growth for a little while. I think it's going to hamper consumer spending. Mm-hmm. It's going to hamper government spending, obviously. Yep. And so I think that's a huge spending kind of, I guess you could say, concession in the debt ceiling legislation that could have a big impact on markets and inflation and the economy overall.
So it doesn't. In that analysis, it doesn't sound like if there's if they're going to drive by, it doesn't sound like interest rates are coming down soon. Then is that safe to say?
No, I think that interest rates are not going to skyrocket. From that supply demand thing with the bonds. Yep. But I think that the economy can enter into sort of like a deflationary period, second half of the year. I think we were already headed there before, but now with this legislation, the government's going to be, fiscally contributing to that. Yeah. So if that happens, then you want to be long bonds because bonds perform well in a deflationary time. Sure. And so so I would think that, yes, interest rates will come down eventually. I'm not, this isn't a tomorrow thing. It's a, 3 to 6 month thing, but
what percent of GDP is government spending? A quarter?
Yeah, something like that. I mean, I know that consumer spending, I think is like 60% or something like that. And then it's just government and then net imports. Or net exports. So.
Okay. Mark, by the way, great background. Just saying.
I'm pulling the Thoreau today rather than the Hemingway.
I see that. You're on Golden
Pond just over there.
Oh my God! You're writing your second book of poetry. I love it.
Yeah.
Very nice.
This will also be unpublished.
That's right. Hey, Mark, are you following this this debt ceiling debate at all, or anything in your wheelhouse?
I think it's interesting. I think, at a very high level, I think it's just charades. I think it's fascinating that the U.S. is the only country in the world other than Denmark that has a debt ceiling. And Denmark's like a billion, quadrillion krona or whatever. So de facto, the U.S. is the only one that really has this sort of throttle. I find that just interesting at a very high level. But what it means for the options markets is I haven't necessarily seen downside skew change that much as a result of this. Like, I don't think this resolution, manifesting itself is taking much fear out of the markets, right? Like, I think there's still uncertainty to the downside. I think people are still coming after protection. Like, I don't think markets wise much has changed because of the resolution.
Yeah,
we're actually in the same place as we were before this was announced.
Yeah, so that leads me to think that, or wonder that, so it's not all solved, because I thought the market would react differently from this looking like it was worked out, and really the market didn't do much at all. I didn't think so. Maybe
I don't think the market priced in much of a possibility of this not working out.
That's probably true.
That's a good way of putting it.
That's kind of more or less,
Yeah, I mean, it looks like, and as Mark alluded to, the charades, and everyone's positioning themselves so that, obviously the Republicans are trying to get something out of this, the Democrats want to keep something in it, and vice versa. So that makes sense, and it's kind of political sort of positioning, what have you, but always knowing that we're going to get through it. Don't worry about it. So that seems how the market reacted to this to me. So
yeah, yep. I think what Jason brought up about the bond issuance, that's going to be the next real decider. Who, like, what tenor, what term, like who's buying, how the government is going to fund itself now that it has the ability to.
Yeah. Jason, you mentioned the word, I think you mentioned the word money market. So I had a little comment on that. I wrote it down. I just found out that money markets are giving 4.8%. Is that right?
Yeah, I mean, that's how much bills are. What's the interest rate on bills? That's like 5 point what? What is it, like 5.5 now?
Yeah, I was like 4.8 in a money market. I'm like, holy cow! That's when I do the calculation of how much money I'm going to make per year on the 400 million I'm going to win in the lottery. I always use 0.045 as my interest rate, and it's 4.8 with money market. It's unbelievable.
Didn't you already win the lottery, Lex?
What's up?
Didn't you already win the lottery?
Oh, that's funny. That's why we're orange shirts. Exactly. Yeah, so I couldn't believe that. That was amazing to me. I was shocked. So anyhow, we had to back up the gold truck and bring it over there to the money market.
Gold truck you own.
And speaking of that, in terms of an investment strategy, I mean, at some point, if interest rates are high enough, don't you put a lot of money from the stock market into bonds at some point? I mean, look at, you're trying to make 8% a year for your life or something like that, or whatever the number is. And if bonds get it to that point, what's the point of even taking the risk in the market?
Well, there's a huge. I mean, the bonds are very much what do they call it? I know inverted, but very steeply inverted.
Yep.
I always look at it and I say backwardation, but again, options always on my mind. But anyway, they're steeply inverted, so that the huge, money market interest rate is only going to last as long as bills are this high of an interest rate. I mean, the 10 years now are down in the. I might have reached 4 not long ago, but it was at like the 3.8, 3.7.
Yep.
Meanwhile, like 2 years are at like 5 point something ridiculous, 5.65 or whatever. So I mean, if you want to make that little 5.65%, it's only going to last you for a couple of years before you're going to have to try to figure out where to park your money.
Yeah.
So what I love in this environment is the classic structured product where you take a zero interest bond, like a bill or whatever, and buy calls, call spreads, put spreads if you're bearish, right? Like use the interest that you're going to generate or theoretically generate from that bond and put it into the options market. Call spreads are great just because you can sell some upside and, to really give you a nice defined range. But That's what I love doing with this interest rate environment.
Yeah. Okay. I like it. I like it. You know what? We're going to move to skew here in a second. That's quite a jump from the bond market and the debt ceiling all the way over to skew. But I want to get a gentleman on who wrote a paper on zero DTEs, and it's from an institutional side. So we should talk with him in one of the upcoming shows.
Who is it?
Chris from Ambrose, Chris Sidiel.
I've got questions for him then.
Okay, good.
Because I read his paper.
Yeah, you have some questions, but it's interesting though, whether you believe it or not, or you agree with it or not. So we can have a little debate about that in a subsequent show. But this zero DTE thing has really been on the lips and tongues of every investor, right? It's all I hear about. It's only questions I get on demonstrations. Zero DTE. So I want to really dive into that in a future one if that's good.
Yeah, well, I mean, this gives me an opportunity to what's the word? Promote Volin Live, which just launched. It launched last week, but now we're kind of like really fully launching. It gives you zero DTE dealer positioning intraday as it's going on, and so I mean, there's been a lot of observations. It's very interesting. I think if you want to save it, I guess till for Chris, we can.
Well, that's interesting. So now that you have Volin Live, is it officially out or no?
Yes.
Okay, so it's officially out. And how much does that update? Is every 10 minutes, 15 minutes?
So we have 4 tiers. One is the regular Volin that just updates in the evening.
Yep.
We have Volin 3, which updates 3 times a day. Once at 11:30 and once at around 2.
Yep, clever. Volin 3, I can remember that. Go ahead.
Yep. Then we have Volin 30, which updates every half hour.
I was going to say 30 minutes. Unbelievable.
And then we have Volin Live, which updates every 5 minutes.
See, now I wouldn't have gotten that one. That would have been harder. So.
Well, Live was kind of just, the highest one. Volin, we didn't want to name it Volin 5 because then it's between 3 and 30 and then 5, you
mean,
get it all mixed up in your head. But
maybe you do like Live and make the E like a 5 or something like that. Make it something kind of cool like that.
Well, I mean, we couldn't also name it like, I think it was like Volin 180, which would be 180 updates a day. But anyway, so I mean, we've observed a lot of behaviors. Chris Chris wrote a paper on it, but Bank of America wrote a paper that kind of completely was the opposite of what Chris observed.
Oh, no kidding.
Yeah, and JP Morgan did too. Also the opposite of what Chris observed. We noticed that there are some times where the zero DTE options are bought puts and sold calls, kind of like the squeeze metrics paper, the JEX. We call it the JEX paradigm.
Yep.
And then even yesterday, there was like an anti-JEX paradigm, which happens rarely, but it happens sometimes, which is very bearish. So, I mean, there's a lot of like, kind of different things. But now, if you're going to have Chris on, you got to let me know beforehand, because I'm going to highlight all the spots in his paper that I disagree with, and I'm going to ask him about it.
Okay, don't be mean. Okay, you got to.
I'm not going to be mean. I'm going to ask him about it. I'm not going to say,
Yeah.
I'm just going to say I'll ask him questions that are going to be pointed. It might be fun watching.
Yeah.
Bring the popcorn.
Yeah. So one of the concepts that they address in the paper, the Ambrose paper, is that zero DTs that institutional players are involved in that more than we think, than the retail public. That was pretty interesting to me. And the dealers are, they're not interacting with that paper as much. I don't know if that's true or not. That's not how that happens, right?
That is not what Harry said.
Yeah, I know. No, you mean Henry.
Henry, that's right. I'm sorry.
Jeez, really?
Oh.
Don't worry about it.
Apologize, Henry.
The best explanation I heard for what institutional players are doing, the most succinct, is that it allows them to separate intraday Greeks from overnight Greeks.
Yeah, exactly.
That, like, as a construct, these ultra short dated things parse out a specific distinct component of your overall exposure, and that's where the institutions are really finding advantages trading these.
Yeah, so that's a great point too. Sorry, but what I understand too is that some of these dealer desks, the trading desks, they have a whole team devoted just to zero DTE, and they trade it as a distinct product within their book, separate from the rest of their inventory. So they got a whole team just working on zero DTE, and they remove it out of the grand portfolio of the firm, which I thought was interesting. I don't know if it's true, but I could see how that could happen, right?
That's happened in the SPX for years, right? Like there used to be like front month SPU traders and back month SPU traders. That oftentimes like the pit would get divided up that way.
Yeah.
It would have to happen like that too, because the implied volatility behavior of zero DTE is so much different than it is in the out weeks and months, because it's going to head to zero. Every option is expiring, so implied volatility becomes zero at the end of the day, whereas it's completely different on the other tenors. So I mean,
right. Yeah, no, I think that's right.
So they do a risk like handoff at 4:00, like where the 2 DTE becomes a 1 DTE becomes a 0 DTE.
Yeah, I mean, it's not just that, but like most of the volume is in 0 DTE, so it's just whatever's out there, and they just kind of expires at the end of the day. I mean, you see, it's all zeros, zeros out of the money, and complete intrinsic value in the money. So I mean, you see it kind of line up like that. That's the way it's supposed to be, right? Yeah. So
my guess is
you don't get that anywhere else. Like,
right. I got to believe the retail person in the zero DTE game, they're probably in the very early morning or right at the opening thereabouts, selling zero DTEs to buy them back for not small slivers, but for some of the theta that they can grab, and they're not letting these things go to expiration at all. So yeah. I think they're selling. Hour or two later, whenever they get X% from their sale, they take it off and do it again the next day, or at least try to do it again the next day.
Yeah, I mean, most retail that I know that are dealing with zero DTE are round tripping pretty quickly.
Yep. I like that.
Or what?
Round tripping. I like that. It's good.
Yeah. Or they try to sell early in the day and hold it. Like people try to sell premium, because it is kind of the premium is a little higher, from an implied volatility standpoint in zero DTE. And that's one of the questions I would ask Chris is, if he's contending that most zero DTE options are sold, which he does in his paper, why is implied volatility always higher in zero DTE than it is in 1 DTE or any subsequent?
Yeah.
It's always kind of backwardized. So you would think that it would be lower if the large group is selling. I mean, those are the kind of questions I would ask, Lex. It's not,
okay. I think they're legit. I think they're fair. All right, we only have a few minutes left. Mark.
Oh, we missed the SKU convo.
No, we're not. We're going to go right to it now.
All right.
So you were mentioning that you read a really interesting paper on SKU and what it's about the reason SKU exists. And we all have our opinions on that, especially from the trading days on the floor and the people are old enough to remember the 87 crash. So what do you have on that topic?
Yeah, so obviously we talk about SKU a lot. I think anyone that's even loosely familiar with an options, profile knows that downside puts tend to be bid over upside calls, that the standard equity SKU curve slopes from, your upper left down to your lower right. And that's not how it's always been, right, Lex? I think you mentioned earlier that pre-1987, everyone was running a flat Black-Scholes, and the standard Black-Scholes model assumes that all, volatility is constant across all the different strikes.
Right.
And so I think 87 showed a bunch of people, some natural intuitions about SKU, why it exists. I think the most obvious reason why people start to grok what's going on here is the whole buyers meet sellers, right? More downside buyers of put protection, more upside sellers of calls, right? That's like the standard reason people come to the options market is to buy protection, sell, overwrites, and that's going to create a supply demand imbalance. Makes sense. I think that buys you time on CNBC or whatnot. I think the next level intuition is sort of like this spot vol correlation, right? That anyone who's been around long enough, you start to see, hey, when things go down, they start to get rocky, and that just makes gut sense too, right? The market's going to move around a lot more when there's uncertainty. That also groks with say commodities, right? That commodities are going to have that upside SKU because when prices go up, it means there's, boll weevils or a drought or, something going on that's causing prices to move around.
Right.
So like this whole like, spot vol correlation also makes sense, whether it's negative in equities or positive in commodities.
That buys you time on options, bro.
That's right.
That'll get you through options, bro.
That's right.
But the third layer intuition that I just saw, it's actually this fascinating book. It's called Financial Hacking.
I'm writing it down.
Yep, writing it down. Who wrote it?
Financial Hacking.
Philip Macon.
Okay, hold on.
I think
Philip.
I'm pronouncing that last name right. But he sort of steps through like an intuitive logic of the derivatives pricing model.
Okay.
And like you can almost read it like sitting at a bar and learn about the Black-Scholes model. It's like sort of that level of kind of logic.
Okay.
And
That's
so
what I do in a bar.
that's what I'm doing tonight. So one thing that's always bothered me, or like kind of seems illogical, is that like if you're looking at a single month and you see your downside put at 25 vol and you see your upside call at 15 vol, I mean that's like a pretty steep skew. But for purposes of illustration, like if I sell high vol and buy cheap vol, and vol realizes no matter what it is, like I should make money, right? Like I've sold 25 vol, I bought 15 vol. Why can't I sell that risk reversal, sell that put, buy that call, and like hedge it and guarantee make money on that? Why can't I collect those 10 vol points? And a lot of reasons, transaction costs. There's like the idea that when it moves to the downside, it maybe moves a little bit more, like that kurtosis of returns.
Mm-hmm.
But the explanation in this book, and the one that I found very intuitive, is that it has to do with the distribution of vol during that time period. That like, it's not like you buy a variance swap and you agree that we're going to measure vol for the next 30 days. Boom, we mark it at 15. What's the difference? All done. It's because with vanilla options, there's time in between. The stock's going to spend some time down by your downside put. It's going to spend some time down by your upside call, and it's going to move around in between.
Mm-hmm.
And that variance isn't totally normally distributed. It's exhibits, and this is where you're going to laugh at me, is the heteroscedasticity.
Okay, hold on. What does that mean? The I don't even know how to say that word.
Heteroscedasticity. And so it's the statistics concept that variance is not normally distributed over its lifetime. That it clustered. The idea, like volatility clusters, is colloquialism for heteroscedasticity.
Okay.
That, if you look at the last 20 years, the VIX's average is, I'm pulling it out of my 14, something 15, maybe something like that.
Yep.
But when it's 50, 60, like you get a lot of high periods of that.
Mm-hmm.
And then you get a concentrated high periods of that. Then you get a long, slow 10, 12 days, right? So the idea that volatility clusters, if you've got that risk reversal on where you're short put and long call,
mm-hmm.
it's going to demonstrate 25 vol when you're at your short put. And to hedge that at your short put, you've got a boatload of short gamma right there. So you're cutting yourself up, hedging your short gamma at your put that your upside call isn't making up for because it's far out of the money now.
Mm-hmm.
So it's realizing the higher vol when it's around that short put. You have your hedging costs, your short gamma management there. And then when it goes up to your upside, you're not able to scalp as much because it's only realizing a 15 vol or whatever it is around your upside.
Right.
So that skew is internally consistent because of the gamma and the distribution of variance during that option's lifetime.
That's interesting. So we had a little method as well. And it kind of speaks to this a little bit, but it was around when you hedge something, try to hedge it in concentric circles. And all that means is that the middle circle, the smallest one, is the most like option to what you just traded. So if you're trading a 25 delta put, the best hedge might not be a 15 delta call in the same month. It might be something around that 25 delta put that may be a little bit cheaper if you sold it, for instance, than what you just sold. So even though you might be buying higher implied volatility on that downside part of the curve, that might be a way better hedge than buying a 15 call with a 10-point volatility skew, right?
Exactly. Maybe you look at another term. Maybe you buy the month out 25 put or whatever.
Yep.
We call that likeness.
Yeah,
like exactly. You want to buy like options.
Yeah. Like options, right? And people ask me that question when I do these speaking things. They say, well, I don't understand. And I said, well, what's the best hedge if you just sold a put for 25 ball. They're like,
buying the same one back.
Buy the same one back for your edge. To
Mhm.
get edge off of that. It's off your sheets and the money's in your bank. So that's the center of the circle. And then as you go out in time and away from that put and so on and so forth, it gets more risky and less structured as you move into farther circles, right? And that's just our verbiage that we use. Hedging a 0 DTE with a 2026 option, probably not awesome. Probably not awesome.
Nothing to do with each other.
Right. No, almost nothing to do with each other. Right.
Yeah. I like when people talk to me and ask me, can dealers hedge their SPX options with Apple options? I'm like, no.
In the right proportion. If you buy 4% Apple options, 2% Microsoft options,
yeah, you'd have to do like a like thing, and I'm like, that's not that easy. I said that's like the least desirable thing for a dealer is to try to use a correlated product.
Right. I agree with that. That's interesting. So Mark, it was financial hacking, right?
Yep.
I like that.
I'm gonna read that one. Is it really thick, like this thick, or is it really thinner?
No, we're talking like 180 pages.
Oh,
I think less
that's
than 200
in a weekend. Yeah.
Yeah.
I'll ask this for Lex. Are there pictures?
Yeah. There are charts.
Okay,
are there cartoons? Is it like a comic book? Is it like Volman and?
Is it? So I want to be able to draw on the pictures too on the charts.
They're good charts, but the kind of lightheartedness to it is there are a lot of good movie quotes in there. Pulls a lot of deep like movie quotes, Simpson quotes. So it's approachable.
All right, you guys get the brain thing. You guys really smart today. That's really good. So I love it. All right, we got to run, boys. Great seeing you. I love the background, Mark. Jason, your hat is doing great things for me on the pickleball court. So thank you for that. I love it. And we'll see you next week, right? I think.
Yep.
And there's more coming on the hub. We're going to integrate this into the hub. There's lots to talk about there. So we'll get on to that down the road. All right. You guys have a great week and a great weekend.
You
Happy
too,
trading.
Take care.
All right, guys.